Two trades that went two totally different directions. One I lost a bunch on went something like this. I was tracking GAP TQ at the time. Its ticker symbol was GAP, GAP. I was following the top-down approach and sector strategy. I charted the stock, and it was channel bound for several months. I had a market trigger set to the bottom of the traded range, figuring that we were heading into a consumer staple safe haven like Christmas. The company was still running lines of credit, so I didn't see the near-term risk for bankruptcy. So I added market trigger, and it filled, and I got the notification email. In the next 30 to 60 minutes, I was in a mad scramble to mitigate losses. I logged into my trading account to view the sea of red. Once I seen it dip below $1, I knew it was going to go much lower. But seeing there was a bounce point to be had. So I threw a market order in at 120 and it got filled. As you see in the chart, it did go much lower and it never did recover. Some of the lessons I learned this day. Once these companies start whispering about things like bankruptcy, even if not true, they tend to sell off hard. Don't simply trust the charts or sectors without also doing research on the companies, as they say history may not repeat, but it often rhymes. Companies that get comfortable shortchanging their lien holders and debtors see no problem repeating the process. One stock I gained a bunch on went something like this. I was tracking drugstore.com, ticker symbol DSCM. The fundamentals seemed to be in place, and the balance sheet appeared clean for a company of this size. I knew there was a substantial amount of consolidation in the sector, and this seemed like a prime takeover target. I found some support level around the 88-cent range. So I placed an order, and it got filled. I also charted my support and resistance levels to see where to take potential profits or to set a stop loss. I was experimenting with trade stops and triggers and realized that market makers would see my trade triggers. In other trades, it was like a moth to light. Place the trade trigger, get stopped out, only to see the stock then take off. This dynamic many traders don't take into account. They just see buyers and sellers. But what about the market makers? A good analogy would be sitting at a poker table. Your cards are faced up and everyone else's is face down. Doesn't seem fair, right? I tried something different this time. I added a very small stop loss around 72 cents and waited until the stock was heading towards the stop loss. Then I replaced it with a very large 74-cent order shortly before it got there. As the chart will attest, the trade worked out very well. Some of the lessons learned this day: if the company's fundamentals are in place and the balance sheet seem to be in order, then use my support and resistance levels to calculate my gain and loss targets. And don't forget about the market makers. They can trigger stops to provide liquidity. Just let that last statement sink in. I don't trust trade channels because I've seen too many times the price will dip or spike just outside of them